Today we are covering the home mortgage interest deduction, a heavily tested area on the enrolled agent exam. The core concept is that taxpayers can deduct interest on acquisition indebtedness for their main home and one other home as an itemized deduction on Schedule A. The exam will focus intensely on the loan limits for mortgage debt taken on after December 15, 2017. The total acquisition debt for a married couple filing jointly cannot exceed $750,000. For single or married filing separate filers, that limit is $375,000. However, any debt that existed on or before December 15, 2017 is grandfathered under the old, more generous limit of $1 million for married couples or $500,000 for married filing separate filers. An exam question will absolutely give you the dates and loan amounts and expect you to apply the correct limit. A great way to remember the current rule is the phrase 750 post 17. A major trap the exam uses is the distinction between acquisition debt and home equity debt. Acquisition debt is a loan used to buy, build, or substantially improve a qualified residence, and it must be secured by that residence. This is where test questions get tricky. For example, if a client takes out a $50,000 home equity loan and uses it to pay off student loans, the interest is not deductible. However, if they use that same home equity loan to build a new addition to their house, the interest becomes deductible because the proceeds were used to substantially improve the home. The key is always the use of the funds, not the name of the loan. The exam will try to fool you by calling it a home equity loan, hoping you'll automatically think the interest is non-deductible. Always trace the use of the proceeds. Another critical area is points. Points paid on an original mortgage to purchase or build a main home are generally fully deductible in the year they are paid. The exam loves to test the exception to this rule, which involves refinancing. If a taxpayer pays points on a refinanced mortgage, those points must be deducted ratably over the life of the new loan. For instance, if a taxpayer pays $3,600 in points to refinance into a 30-year mortgage, they cannot deduct the full amount upfront. Instead, they can only deduct $10 per month or $120 for the year. Expect a question that requires you to calculate the annual deduction for points on a refinance loan. Finally, do not blindly trust the amount reported in Box 1 of Form 1098, Mortgage Interest Statement. This form simply shows the total interest the taxpayer paid. It is not the final deductible amount. If a taxpayer's loan exceeds the $750,000 limit, they must perform a calculation to determine the deductible portion of the interest. For example, if their loan is $1 million, they can only deduct the interest attributable to the first $750,000 of the principal. This means they can only deduct 75% of the interest reported on their Form 1098. The exam will present a scenario with a high mortgage balance and a Form 1098, testing whether you know that a separate calculation is required and that the form itself is not the final answer.